Citigroup, a U.S. equity strategist, Scott Chronert's with us at Post 9 as we get set for earnings season to kick into higher gear. Good to see you, Scott. Welcome.
Great to be here, Carl.
Is the market really just focused on Q2 earnings?
Well, I think it's focused on Q2 earnings, but I actually think it's increasingly focused on the follow-through and the aftermath of tariffs and other policy news in terms of what it means for 2026. As we go in the back half of the year, you usually flip forward on the calendar. And right now, when you're looking at the way the consensus earnings expectations are set up, is for a pretty decent acceleration next year. I think that's where a lot of the market focus is beginning to shift.
And is it because margins will absorb some of this tariff pain?
Well, we've always viewed the tariff issue as much of a margin issue as an inflation issue. But what I think we've learned since the Liberation Day dynamics, I like to use it in sort of California earthquake terminology. You had the initial earthquake, big shock. Markets don't like shocks. It gets very unsettling. Time passes, you get the aftershocks, you get these mini versions, you're a bit more comfortable. And I think that's where we're going. We think the tariff discussion goes from an index level issue to much more company-specific, industry group, maybe even sector. So that mitigates the influence and allows investors to differentiate among who's impacted and who isn't.
Still, though, isn't an average tariff rate of, if we get to 20, isn't that kind of material?
It's a big deal. Yeah, we're modeling 10% plus a little bit more for our 261 estimate for 2025. So we're going to, we have to deal with this issue. It's going to nudge higher the way we think tariffs impact negatively. And so I wouldn't be surprised to see a little bit of a pushback in terms of the way companies are talking about the second half earnings trajectory.
What about the Powell risk? Do you think that the market is underpricing the increasing political pressure? Are you as unnerved about this as I am?
I'm not as unnerved, Sarah, just because the S&P has shown you that it can live in a 4.5% 10-year yield world. When you look at the action under the surface, that part of the market that still has had a lagging element to it have been those that are more interest rate sensitive. Think the home builders, think consumer discretionary.
What happens to rates, though, if they really start to move on this?
If rates begin to move higher or lower?
Well, I mean, if the White House begins to move on trying to find cause to fire the Fed chair before his term is over, what happens to rates?
I think that's another potential shock effect. Okay, that's going to unsettle investors at first. Then you have to wait and see, right? But where I'm kind of going with this is that if you look at the way the Fed regime has gone over the past 2 or 3 years, the U.S. equities have been kind of moving sort of contra to it for a lot of reasons, mainly because you still have this underlying AI-related infrastructure growth narrative that's been supporting a big swath of it. So does the Fed matter in that? Maybe, maybe not. Ultimately, what you want to see is inflation continue to come down. You want to see a little bit of pressure off of the longer part of the curve, so you feel a little bit better about longer-term investment decisions as a corporate. But in aggregate, I think the market's in pretty good place here in terms of being able to navigate sort of some of the noise. But the reality of a shift would be sort of a shorter-term issue.
That's not a longer-term issue around credibility of the U.S. dollar?
Well, I think it's a longer-term issue, certainly in that context. I think we want an independent Fed. Yeah. I don't want to see anything that disrupts that. But we'll cross that bridge when we get to it. But I think the way we're thinking about it, if we're going to kind of lead with a fundamental perspective on where our equity market views are taking us, this is an issue. To me, it's not necessarily the driving issue right now in terms of what's influencing U.S. equity fundamentals.
Clearly, no.
Do you think the discussion regarding AI and the impact on jobs is getting more clear?
I think it's going to continue to get more clear. I think we're kind of watching the employment data, what's going on here, what's going on. I mean, there's no doubt in, I think, most people's mind that the AI influence over time is going to be via productivity lens. And you're going to be able to measure that differently, different parts of the market, right? And so I think we're going to have to be attuned to how that shows up. We've been talking a lot about the EBITDA margin trend for the S&P 500 over the past 15 years. It's been up and to the right. The S&P 500 has benefited from an ongoing margin improvement component. I think that's part of the AI narrative longer term. But, I think we're going to have to kind of watch that interplay with some of the economic conditions and the employment metrics. Again, I like to keep focusing on S&P 500, i.e. Wall Street, is not the same as Main Street, broader U.S. economy.
That said, though, do you think earnings growth over the next 5 years can beat the long-term average?
I would say right now, if there's an issue that we've got with the market, is that expectations for the next 5-year earnings growth is as high as we've seen, okay? So there is a lot of burden on beats and raises, particularly out of this growth part of the market. And that's where we get a little bit unnerved that, okay, our view for the second half is that you're setting this thing up for volatility dynamics to come into play, give you triggers for pullbacks, but we still have enough conviction in the underlying fundamental circumstance structurally for the S&P 500 in particular that we want to be looking to buy pullbacks.